Hello and welcome to our Exponent second quarter of 2021 review. My name is Benoit Poliquin. I'm the founder and one of the portfolio managers here at Exponent Investment Management. So let's look at some of the highlights for investors during the second quarter. As always, we've broken down the presentation into two videos. The first video is a much shorter video with just the highlights. The second longer video really will go through some of the charts and the research that went into our conclusions. As always, you can use your video player to accelerate or pause. Thank you so much for watching. So let's start with our performance summary table. What's interesting this quarter is the Canadian market did very, very well. So it was the best performing market with a return of 8.5%. We then move on to the S&P 500 and the NASDAQ, which was tech heavy, also had a very good quarter. And you can see the year-to-date numbers are quite strong. Europe is coming on as well, which is new, where most of the return for the year happened during the second quarter, as are the global indices. Bonds had a decent quarter, but we're still having a rough year. And the Canadian dollar unchanged. Oil price is absolutely on fire. Volatility in the markets has come down dramatically. What's interesting here is the yields in Canada and in the US really haven't changed much, but the shape of the yield curve, you might have heard me talk about it in previous videos, whether the difference between short-term interest rates and long-term interest rates is, if that difference is substantial or not. It's called the yield curve. And what it matters is as the yield curve gets flat, the difference between short rates and long rates diminishes. That has an impact on banking activity. What we want to see, if you want an economy that is doing very well, is actually a steep yield curve. And as the yield curve flattens, the economic activity tends to wane a little bit. So here we're seeing a flattening of the yield curve both in Canada and the US. If we move to the performance attribution, if we look at what happened in the US, top right box, you're seeing the usual suspects in terms of large capitalized, the largest companies of the S&P 500 are the technology names. So Microsoft, Apple, Amazon, Facebook, Google, they're all up there. Adobe, so really the non-tech name of the top 10 performance names, if you will, is Berkshire Hathaway, which is Warren Buffett's company, which really was catching up because for a long period of time that name was lagging. If we move to Canada, which is the lower right corner, we're seeing that Shopify really had basically provided 22% of the positive movement of the index was really Shopify. And then it's really the banks and the two largest oil and gas company and the largest pipeline company. Of course, BCE had a really strong quarter as well. So what you can see from there is that in the US, the performance is fairly concentrated, or very concentrated, very much like the same time last year. Whereas in Canada, Shopify accounts for 22%, and then we have the banks. So again, we're still looking at a focused performance. If we look forward to the post-pandemic world, the real question is, when does the back to normal happen? So in Canada, we're looking at 40% of the Canadian population is fully vaccinated, 60% plus with one dose, which is actually, if you look back at, say, 3 months and 1 quarter, even 6 months ago, it is a dramatic improvement. So when does the back to normal, the lockdowns happen? I'm not trying to make a public health policy perspective, we're just looking at it from an economic perspective. You need people moving around in order to have economic activity, because at the end of the day, GDP is really just money flowing through the system, and you need people to move it around in order for that flow of money to happen. We're worried obviously about other possible COVID subsequent waves, if you will. Not so much the waves, but the public health mandates around shutting down the economy. So that's not just a Canadian story, it's a global economic story. On the economic front, what are we worried about? We're really worried about inflation. Whether it takes over like 70s style, where the prices of everything go up substantially and consistently for many, many quarters. Right now, the Federal Reserve and other central banks are taking the view or the position that the inflation is transitory, meaning it will come back to normal. In the past, coming out of recession, it is entirely normal that as demand comes back quicker than supply for both goods and services, it is normal to have a spike or an uptick in prices. Longer term, whether this increase in prices will have an impact on spending patterns, something that we're looking forward to and trying to understand. Asset price inflation is probably, for us anyway, for me personally, the biggest story is as houses and other durable goods, if you will, like cars, go up in price, there's less and less discretionary income available for other spending on a consumer level. And the asset price inflation also has another impact on monetary policy, i.e. central banks. When and if do they raise interest rates, and public policy. You can't have a well-functioning economy if the asset owners, whether it's a house, a business, stocks, whatever you like, and the renters, if there's a large gap between the wealth effect of those two economic groups, if you will. So public policy, you might see some larger scale decisions made to try to bridge that gap, which was brought upon by asset price inflation, which was brought upon by central banks lowering interest rates. So really, they need to undo some of the actions that they took because of the pandemic. Demographic realities, they were there before COVID. Aging population, the mismatch between skills required in the economy and the skills available in the labor pool. The global trade and policy shifts, those are also things that we're looking forward and trying to understand and to be able to capture some of these prevailing winds. What has not changed in our strategy, keeping an open mind, be able to be flexible and pivot into or out of certain trends. Our strategy always encompasses having an open mind to multiple outcomes, from the better than expected to worse than expected. And that leads into certain portfolio adjustments, meaning buys and sells. And finally, respecting the low probability events that have a high impact, both on the better than expected front and the worse than expected front. So let's look at 2021 and beyond. So what hasn't changed, our focus on dividends and or companies that reward shareholders by share buybacks would be another way for a replacement, if you will, for dividends. Quality balance sheets, proven management, really a global brand or global approach, or at least aspirations to, is certainly a plus for us. Valuations, buying stocks when they make sense and selling them when they really get out of whack from a valuation perspective. And really not so much ignoring the headlines, but just not being swayed by them. On the adjustment side, with really rising interest rates, we've had a pretty substantial rise in interest rates in the past 6 months, and impact and certainly a higher expectation around inflation. Consumer discretionary income, we talked about housing and inflation, that has an impact on the portfolios. The migration, and we're going to talk about that in the longer videos, the migration patterns stemming from the COVID and pandemic or public health initiatives, if you will, mainly the working from home. The K recovery, which is a fancy way to say the difference between asset owners and the renters or the providers of labor. And finally, covered policies. Those adjustments are ongoing in terms of what's going on in the portfolios at the moment, and we anticipate to have those continue on. Thank you for watching this shorter video. Thank you so much. If you have any questions or comments, by all means, drop us a line. I'm Benoit Poliquin from Exponent Investment Management. Thank you so much for watching.